UST imploded. Something's up with the Celsius network. Now we have USDD, another stablecoin offering even higher returns than UST. I had to learn more, but as I jumped into this, something went wrong. Like, really wrong. Suddenly I had this big story to look into, and it was starting to look like Luna version 2.0. See, USDD is an algorithmic stablecoin on the Tron network that promises returns up to 30% APY. I like to give everything in crypto the benefit of the doubt before judgment, but of course I'm skeptical after the whole Luna UST thing. And hey, maybe, just maybe, I'll discover a gem that actually pays an insane yield in a safe manner. I started with the currency peg section. This is where UST failed, and first I saw their overall promise to
USDD resolves short-term price fluctuations and cyclical price risks with its responsive monetary policy and mintage mechanism.
And then I saw
how it stabilizes the price and grows the transaction scale.
Who doesn't want a huge return with stability and no risks? But how does it actually work? Well, in the white paper, it says that USDD will be pegged to the US dollar at a 1-to-1 rate. Then I got to the bit about over-collateralization. The idea is to have an insane amount of high liquidity digital assets backing this token. Right, so that looks good too, and it makes sense. Blast the collateral to the moon and it should be much more secure. So far, we can see a sensible setup for achieving stability and liquidity in an algorithmic stablecoin. Next, I had to look at the mechanism that burns tokens to keep this thing right at $1. This is where I expected things to get complicated until I found this.
The USDD market follows the simple law of supply and demand for a pegged currency.
I like how they say simple supply and demand. So you read it and you're like, oh, simple you say. You know, I guess all my concerns are gone. Maybe this time, finally, we have a safe, high-yielding algo stablecoin. Except it depegged already, trading under $1 for more than a week, and people are losing their minds. They're confused. All of this happened despite over-collateralization and the burning mechanism. Even the simple law of supply and demand hasn't seemed to help. So what the hell's going on here? Theories about what went wrong are easy to find. They throw around big words like rug pull and Ponzi and discombobulation. Okay, no one's actually mentioned discombobulation, but it's just a matter of time. Yet this feels different from those other crypto lending crashes. Look at all that lovely collateral, and it doesn't seem to have liquidity issues. So is this a repeat of Luna or Celsius, or is this some other type of problem that we haven't seen before? Maybe it's just nervousness in the market. I mean, we're all a little bit exhausted right now, and people get spooked. It's totally normal. Plus, believe it or not, most of the time when a stablecoin depegs, it's totally fine. It's not usually like a UST collapse that just changes an entire market. So I still needed to know more. I went back to the day of the depegging, which sounds a lot like that time. Never mind. This is when USDD dropped under $1, and the Tron DAO reserve sprung into action, snapping up even more assets, but it didn't get it back to $1 for some reason. And even weirder, they say that it's not even depegged. Up to a 3% drop is normal, apparently. And again, they have more cash than they need. So it's one of those non-depegging events. End of story, good night? Not quite. I didn't remember reading anything in that white paper that it's normal to have 3% volatility, so I went back and checked. I reread that the promise is to
maintain the market price of USDD around the target price regardless of market conditions.
Maybe supply and demand isn't as simple as we thought. At this point, I started to think of USDD like a hot air balloon, or like a Zeppelin, because that's way cooler. Maybe we'll stick to the balloon for now. If the balloon needs more height, they turn up the burner. This is like when the USDD token loses value. It opens the opportunity for someone to buy one USDD for under $1 and then swap it for $1 worth of TRX tokens. The USDD gets burned and the TRX gets minted, and USDD should, in theory, rise. Then eventually it'll hit $1 again, at which point it doesn't make sense for arbitrageurs to do the swap anymore. Now, if the balloon climbs too high, they would... I don't actually know how balloons go down. Oh, vents. How could I ever forget? In USDD, opening the vents means expanding the token supply to bring the price down. Simple supply and demand. More supply, same demand, the price goes down. So the reverse happens. TRX gets burned and more USDD is minted. Another small profit for the trader and the price stabilizes. In other words, arbitrage keeps that price right at $1. People are encouraged to take part to make those small profits. So not being at exactly $1 creates a money-making opportunity that doesn't exist if it's at $1. And by the way, right now that arbitrage opportunity isn't open to just everyone. But all of this sounds almost too easy, doesn't it? Does the process only work when it climbs just a little bit high or a little low? And how does it not give them enough control to get closer than that 3% margin of error that they mentioned? And what would happen if USDD went down to 90 cents or 80 or 47 cents? This is where UST failed. The system wasn't built to quickly fix that sharp of drop. Is USDD built to fix something like that? To me, this minor but sustained dip in price could be a sign that they're not in full control. They just turned up the burner and it hasn't really done anything yet. Let's come back to Earth for a second. Before we look at that 30% APY, maybe you're sick of crypto lending and you want to try something else. Well, let me introduce you to today's sponsor, Pionex. See, many exchanges offer trading bots, but Pionex is unique because they actually specialize in them. You could have your classic bots like the spot grid or the reverse grid or DCA bots, but you also have advanced options like their spot futures arbitrage bot where you can profit in any market environment, or the dual investment bot, which is essentially the easiest way to do crypto options. If that last one interests you, they're actually running a promo right now where you can use $1,200 of their money to run that bot and you get to keep the profits. They'll be linked down below. Okay. 30% APY. This is far more than Anchor Protocol, far more than Celsius ever offered. Crazy profits. I mean, $100,000 invested at 30% APY for 20 years yields $18 million. So the math shows that this is simply not sustainable for the long run. But can it be justified in the short run? The 30% return was mentioned by the controversial Tron founder Justin Sun, yet the white paper doesn't mention this at all. And the official site just says this. So how do I get that juicy 30% or more with no risks? I'm not the only one asking that question. It's earned by staking on the network. But it's not all that clear how exactly that works under the hood, like internally. There are so many parallels to Luna UST here. They're both algorithmic stablecoins. They both promise these outsized returns. And remember how people behind Luna and Celsius were saying everything was all right until it wasn't? Well, that's the same sort of feeling that I'm getting here. But UST doesn't have the same over-collateralization that USDD has. UST was almost entirely backed by the highly volatile Luna and a little bit of Bitcoin. Celsius, simply put, ran out of liquidity. Those problems have been avoided here. And right now, USDD's market cap is far smaller than Tron's. Also, apparently, it doesn't produce new Tron tokens when it falls. Maybe Justin Sun has the answers that I need. He said that he still believes in algorithmic stablecoins, and he wants to make them more decentralized. USDD is planning to go full decentralized later this year. Sun thinks that Luna just grew too fast and had too much leverage, but I kept getting this nagging feeling that there had to be more to this 30% return. I just wasn't satisfied yet. We can't take this stuff lightly. These huge promises ruined so many lives with Luna and UST. People were using the Anchor Protocol how it was advertised, as this simple savings account, and they lost everything. I was personally hit hard by UST. So what happens next? I'd love to tell you that it's safe to just sink your teeth into that 30% and get on this wild balloon ride. But we've been burned before, and I just don't believe that 30% can be plucked out of thin air. Some people think that there's a short squeeze going on, that Tron is keeping USDD at just below $1 in order to incentivize traders to short Tron. Then they'll use a little bit of their capital to repeg the stablecoin, potentially causing a short squeeze, launching up the price of Tron. And as crazy as this sounds, it's actually kind of reinforced by the fact that Justin Sun tweeted the exact same thing as Kwon when UST depegged. If this event was in fact as serious as it seems, would he mess around like this? I mean, maybe. I think some people will lose money on USDD and others will earn it, and I know that's hardly an earth-shattering prediction. We just don't know how reliable this new token will be. We don't know how this 30% APY will be paid long-term, and we don't even know if the founder has a plan to mess with shorts and make a boatload of cash doing it. What we do know is there's not enough information yet to understand exactly how this will play out. Any investment here will be a gamble or gut intuition.